In this video, traders, let's talk about adding to losing trades. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. Controversial subject, this one, I know. So let's approach it from the real world and let's define a losing trade. So a losing trade is a trade that has gone against you. So we're going to call one tick against you a loser. If you buy at 50, it goes to 49, that's currently a losing trade. That's a losing trade. Now, the general consensus is don't add to a losing trade. And I'm pretty much in agreement with that. I think that for the majority of people, adding to a losing trade, forgetting about the operational side, which we'll look at in a moment, and the potential advantages, are nowhere near, they don't outweigh the psychological impact and little chink in the door that opens up if you start to add to losers. Because if you start to add to losers, I think it can cause a waterfall and cascade of just bad habits, and it could just be the worst for your trading because you're in the biggest size positions on your losers, and it just doesn't work mathematically. And so, generally speaking, I think the no, don't add to losers is probably for most people the correct advice. However, there are times, maybe if you're more advanced, if you've got your discipline dialed in, do not add to losers at all if discipline is not dialed in, where you might use the oscillations of the market to your advantage. Again, I want to reiterate that for most people, this just triggers psychological bad behavior. So adding to losers is generally a bad thing regardless. So easy to have a golden rule of, I do not add to the position unless it's a positive trade. That's simple as that. That's very much an easy rule to do. But let's say you're in this condition and you're like, okay, I bought this flag here, for example, break of the flag, and you're long from this point. And you go, okay, you know what? I'm going to put my stop under the low of the day. And your target may be up here, gap fill, for example. Okay, so now you've bought here, the price is going your favor, then it starts to stall a bit and comes back down, but there's no real place that you've pulled your stop up yet. Your management has said, hey, that's not gone enough for me to move my stop. My stop is still going to be here. Fine. Now you start to see some kind of bottoming pattern behaviors. So you see a little double bottom here. Maybe you see kind of this type of flag pattern here that's come off the lows. And so you may then go, right, okay, I have seen another trade that is still valid because I still think this target here is going to be hit. The stop hasn't been triggered. The trade is not negated. And so you're left with a bit of a dilemma. You go, okay, well, I still think this is all fine. I still think, and maybe let's assume you haven't got any time-based stop on it. Everything's still lined up for how you want to take the trade. I still think this trade is valid. I'm still in the trade, otherwise I would be out. Now I'm seeing another setup that I like within the same realms of the trade, but it's in a losing position. It's a lower price in the case of a long or higher price in the case of a short. Should you take it or not? Now let's look at the pros and cons. So the pros of this are that if the trade you think is still valid, then this might be an opportunity to add more size on a good trade. Fine. The cons are that you are now increasing your risk perhaps more than you planned. And that's a big drawback potentially, because if you've allocated a risk unit to this and then you allocate another risk unit, you doubled your risk without taking twice the size on the initial trade. And the answer could be, actually, if I thought it was worth that, why did I not allocate that in the first place? But your comeback to that is going to be, actually now, this trade looks better. And this is where, if you have this perfect storm of scenario and situation, where you can potentially consider doing this. So imagine you have this, right? You have this scenario, and let's say we bought at this level here. I'm going to say this level here because it's going to, otherwise it's going to not look accurate. I've kind of just drawn it slightly out, but you get the point. Okay, and we are long from this point here. Flag break, we're long here. Let's say we're long one there. Great. Now we're still thinking that target, but it's messing around. At this point, we thought we were going to get stopped out, but actually now it double bottomed and it ripped off that low and it started to flag here. And you said, actually, look, this is now a better trade because it's tried to push to the downside, failed. We've found buyers. We've ripped off that double bottom. We're flagging at highs. It's now actually a better trade. I'm still in this trade anyway, but this is a better trade. So at that point in time, it's a slightly worse price, right? Because if I kind of extrapolate out, you'd be here. But let's say you're buying at this point here, number two. Yes, theoretically, you're adding to a loser, But in the context of what you've seen, that's a very different scenario from the person who just buys here and then buys here and then just uses the fact that the price is lower to add to the loser, which is a complete no-no, regardless of however you want to wrap that, that's just a no-no. But if you have a certain scenario where the trade is now even better and it's still valid and you want to express that and say, hey, you know what, this is worth adding the additional risk, then you theoretically, yes, you're adding to the loser, agree, because it's a lower price, but there's so many more positives to it. Now, how do you manage that? Of course, you either go, right, do I add everything and put the stop there ×2? Do I put a stop a little bit tighter? Do I treat it individually? My preference is that you treat the additional trade individually if you're adding to a loser, only because, and this is not something that I do very, very rarely, if at all. I can't remember the last time I've done this type of thing, because generally speaking, I just want to not even be entertaining an add to a loser. So this is a really unique scenario where the trade is still valid, the trade is now better, and the price is lower. That's unlikely. But we've got to look at all these scenarios. So I want to be prepared and planned and go, and you might watch this video and go, no, it's not adding to a loser. That's good. At least we've explored this together and we've seen the scenario that might occur, so you're not going, oh, shouldn't I? You've thought about the whole thing and gone, right, I know what I'm going to do in that scenario. So even though this is a rare scenario, in this case, you might go, okay, I'll buy it and I'll just have a stop on that portion. I've got my initial stop on my initial portion, treat them as two separate trades. Yes, you are adding and you're doubling the risk on one idea and one theme, but if you treat them as two separate trades, which they probably are because the trigger on the second one is different from the trigger on the first one, even though the target's the same, that then becomes a little bit clearer and easier in your mind. It's no real difference to you being stopped out potentially here. Let's say it came lower and stopped you out, so you're out of the trade now, and then you see the trade setting up again. It's in period of time, something's gone further, you still think it's valid, you take that trade. That's really no different. It's no different at all, because just because you've come out of the trade doesn't mean that allows you to suddenly take another trade. You're in the trade still, and yes, you are potentially adding to a loser, but hey, you would take that regardless if you're in a trade or not. So this is where it gets interesting, why you can even, okay, the rules are there for a reason, right? Rules and general adages in trading are there to keep you on track and stop you messing up and doing things you shouldn't be doing. But there's some kind of edge cases that need to be considered. And what will you do when you get yourself in one? And I'm not quite happy with you if you say, hey, I'm never going to take a trade that's a lower price. Fine. But if you say, hey, listen, if the trade is still valid and it's even better, and I would take the trade even if I wasn't in that trade, then maybe it's something to consider, because the risk is no more than if you got stopped out and took it again, the daily risk. So it's maybe something to look at. It's not quite as black and white, guys, as we like to make out sometimes. There's these edge cases, there's these opportunities that maybe, that might be a really good thing. It might be like, okay, you know what, I will take it. And whilst the trade, whatever price it is, whether it's between my stop and here, I will take another setup if I think that it's better than the first. I'm happy to allocate another risk unit to that trade. All right, guys, adding to losing trades, controversial. Let me know your thoughts on this one. Interested to hear how you think about adding to losing trades, or losing in inverted commas trades. Take care. Bye-bye.